keep in mind to just consider this information. Don't consider this tax advice. This is not legal advice. This is just information. The tax code is very complicated. It's extremely complex, and some of this stuff might apply to you, might not apply to you, and it's a good idea to speak to a CPA or some sort of credentialed tax professional before you do anything with this information. But with that being said, let's go ahead and start answering some questions. And here is a really good first one to start us off. And the first one is, I've heard a lot about S-Corps and how they can save you in taxes. I've also heard the deadline to do so is March 15th. Could you tell me more about that? Yes. So, yes, there is a deadline of March 15th if you have a current LLC in place. If you have an LLC in place, that's been in place, like coming into the 2025 tax year, let's say that this LLC was in existence before 2025. Like, let's say that you set it up sometime in 2024 or in the past. As long as it's in existence coming into 2025, you have a deadline of March 15th to make your S-Corp election with the IRS, which is essentially what turns you into an S-Corp. It's filing paperwork with the Internal Revenue Service. Now, it's important to do that by the March 15th deadline, of course. Now, and let me just kind of explain why. If you don't do that, if you don't become an S-Corp, let's say that you just stay a sole proprietorship, you stay an LLC, or you kind of stay at your current structure, you're likely overpaying in self-employment tax. That's kind of the main gist of what an S-Corp does, really, is it reduces the amount in self-employment tax. So let's say that, for example, you have a business, you have like a consultancy or something like that, and you are making gross total income, you're making $150,000 a year. Let's assume that. And let's also assume that you have around 30 grand in business expenses, something like that. You can write off business expenses. So then your net income is now $120,000. Before you become an S-Corp, you pay the maximum amount of self-employment tax on that $120,000. So the self-employment tax, by the way, it's a flat tax rate of 15.3%. So in this case, how you calculate your self-employment tax is you take 120 grand and you'd multiply it by 15.3%. That's how it works. So all of your money is subject to that tax rate. With an S-Corp, though, things work a little bit differently. And what you do is you form an LLC first, and then you make an S-Corp election with the IRS, with the feds. And what happens is once that paperwork is filed, you become employed as an employee by your own company. You become an employee of your own LLC. So now that you're an employee, you'll receive a paycheck. Your business will pay you a salary, a W-2 salary, just like you'd make if you worked for someone else, as a W-2 employee, like at a corporation or something like that. But the advantageous thing about S-Corps is that the only sort of portion of your money that you make in the business, the only portion of it that's subject to the self-employment tax now is your salary amount. The rest of it is not. The rest of it, you can think of it like business income or leftover income or whatever you want to call it. But the rest of that income is simply not subject to the self-employment tax anymore. So, for example, let's go back earlier and let's use the $120,000 net income situation as an example. Now that you're an S-Corp, pay yourself a salary. And in a situation like that, let's assume that someone is paying themselves a $50,000 salary, just for this illustration, just for illustrative purposes. The first 50 grand is still subject to the self-employment tax. It's still subject to the payroll tax, essentially, that 15.3%. But the other 70 grand or just the rest of your money, kind of outside of your salary, is no longer subject to the self-employment tax. And the technical name for that money are distributions to yourself. It's not salary, but it's still income to you. You can still pay it to yourself. And you can take a distribution whenever you want to. And essentially what it is a distribution and is an owner's draw. You can think of it like that. But in that scenario, that's $70,000 that you're no longer paying the 15.3% self-employment tax on. So if that's the case, that should save someone around $11,000, $10,710 in the self-employment tax. So, as you can see, once you reach a certain income level, it can become, quite advantageous to go the S corp route. Here's a good question. I went to go ahead and make a new checking account for my business. Everything went fine, but they told me my business is inactive. What does that mean? So what that might mean is your LLC is inactive with the Secretary of State's office. That's probably what that means. And what I mean by that is you form an LLC. Typically, you form it where you live, the state where you live, and you form it with that state's Secretary of State's office. That's where you form an LLC. And likely, if the bank is saying that your business is inactive, it means it's inactive with the Secretary of State, which means maybe you haven't filed an annual report that you need to file, or paid, an annual fee or something like that. So you might be inactive. So what you might want to do is go to your Secretary of State's website, look up your LLC information, and see if you could just resubmit it or recertify or make it active online. Oftentimes you can do that right online. But also too, it's a good idea to where if you've got a lot of complex stuff going on, if you've got a lot of deals and whatnot, it might be a good idea to at least speak to an attorney as well before you do any of this stuff, especially. What's the difference between an ITR and a BTR? Oh, interesting. Well, I haven't heard that question yet, but those are terms. Those are just tax terms. When you hear ITR, it very likely means individual tax return. When you hear BTR, it very likely means business tax return. And kind of where that comes into play is when you are an S corp, you now have two tax returns instead of one. You now have a business tax return, an S corp corporate tax return, and you still have your personal return. So now you have two. So that's where the BTR term comes in, is that business tax return. Why do we have to pay ourselves a reasonable compensation for S corps? It's a really good question. Well, at the end of the day, the reason that you have, let me back up. Let's talk a little bit more about reasonable compensation. I will hear all the time, from people, and it's a really good question, is they'll say, okay, well, if I'm only subject to the self-employment tax on my salary, then why not just pay myself like $1 in salary? Why not pay myself like a bubblegum's worth, like 50 cents in salary, and take out the rest in distributions and save a whole bunch of money on the self-employment tax? And my response is because that would probably significantly increase your chances of getting audited by the feds, unfortunately. What the IRS says about the salary is that the salary has to be reasonable. And what's interesting about it is they don't give an objective method or some sort of equation to calculate a reasonable salary. So it's a facts and circumstance test that either yourself or a tax professional can help you come up with. Your tax professional or collective, by the way, could help you pick a number. They could give you a suggestion. At the end of the day, the salary is up to you. On how much you pay yourself, it's your decision. But you are able to get some guidance or some suggestions from other parties or professionals. Ooh, here's a good question. I just moved states. How do I move my LLC to a different state? Do I have to dissolve it? Before I say this, before you do anything with this, speak to an attorney. It's very important. This kind of stuff is very complicated. I don't specialize in it, and there's professionals that specialize in it, specifically. But just generally, what I've seen is you've got a few options when you move LLCs from one state to another, or when you move from one state to another while having an LLC in your home state. So let's say that you're living in Florida and you have an LLC in Florida, formed in Florida, and you move to California, and you're now living in California. What you'll have a few options. What you can do, first of all, is file a foreign registration. That usually satisfies the compliance requirements for states when you move. But at the very least, California would likely require a foreign registration. And it's essentially paperwork that you file with the state of California that gives information about the Florida LLC and lets the state of California know that you are foreign registering that LLC in the state of California because you're living there in the state and you're doing business. So that's what they require. You can also do things like domestications or conversions, things like that. So there are ways to convert a Florida LLC over to a California LLC. And it's this complicated process of shutting it down and reforming it in another state. But that's something that you definitely need some support from, a registered agent company to do, some sort of an attorney to do. That's very complicated, and I would not do that yourself. But you have a few options when you're moving from one state to another. What are two mistakes people make when becoming an S corp? Ooh, that's a really good question. Well, one big mistake is the S corp form that you file with the IRS to become an S corp. It's called Form 2553. You have to use a physical signature for that. You can't use an electronic signature. So if you fax it in or if you mail it in and it has an electronic signature, they will reject it. So that's one big mistake. And sometimes you're waiting a long time for an S corp to become approved. So it's really important to submit that form correctly. And frankly, if you're thinking about becoming an S corp, schedule a call with Collective. We'd love to have a conversation with you. And before anyone joins our services, we offer a free call, with an advisor, and they'll go through and see if Collective would be in your best interest, see if you could possibly benefit from an S corp. So please, feel free to schedule a call, and you can do that on our website, collective.com. Feel free to send us a message here on Instagram or one of our social media pages, and we'd love to set one up for you. But the second mistake, what's another mistake that people make when they become an S corp? I'd say probably another mistake is they'll become an S corp, they'll file the form to become an S corp, and in all year, they won't perform any of the administrative steps that need to be done to run an S corp. So when you form an S corp, you have to run payroll. You've got to track, a balance sheet in your accounting systems. You got to do all these complicated things. And if you wait to do them at the last minute, they're a lot harder to do. Sometimes they're technically still possible to get done if you wait, but it's not a good idea and it's not a fun time. So I'd say that's probably the second mistake that people make, is they don't make sure that their S corp is organized and functioning properly throughout the year. But that's also where we come in. We essentially come in and allow you to focus on your business, and we'll handle all the administration for the S corp. What's the best way to take distributions? That's a really good question. And I kind of like to think of it. You can think of you can think of how you get paid via an S corp in two main ways. One way is your salary, your W-2 salary, and that will flow from your business account, from your business bank account into your personal account through our payroll processor as a paycheck, just like a paycheck. So, that can be paid weekly, monthly, bi-weekly, whatever is most convenient for you, we can structure it that way. Your second sort of category of earnings are your distributions. And how you take a distribution is really, there's only distributions are only easy. There's not even really a hard way to take distributions. All you do to take a distribution is you transfer money from your business bank account to your personal bank account. You make an ACH transfer, and that is a distribution. That's all that is. There's no sort of formal process that needs to be done when you pay yourself distributions, but it is a good idea to track it on the balance sheet to handle that. So keep that in mind when you're running an S corp. What are some of the negative sides to S corps? Well, it kind of depends. I mean, because I guess I would say there are situations where an S corp could save a taxpayer a lot of money. I've seen it time and time again throughout my career. But there's also situations where the tax savings that it does provide isn't necessarily worth the administrative burden that you have to take on to get those tax savings. So in other words, sometimes with an S corp, the juice isn't worth the squeeze. If you want some lemonade, you don't choose lemons that are hard to squeeze. You don't get much juice out of. That was a terrible analogy. But at the end of the day, the juice isn't worth the squeeze sometimes with an S corp. And what I mean by that is if you're making a certain amount of money, and what Collective says, we give a general guideline of $60,000. We say that Collective is likely in your best interest if you're making $60,000 or above. The reason we say that is because eventually, once you drop below that $60,000 mark, the amount of money that it costs to be an S corp, to run payroll, to pay a company like Collective, to pay our service fee, to pay a CPA or someone to help you out with all of this, usually the cost of doing it is above what you'd save with the S corp. So if that's the case, what's the point of even going down this path if you're not going to save any money, if it's going to cost you money overall? So just keep that in mind when you're thinking about becoming an S corp. If you're making below $60,000, it might be a good idea to wait, to hold off until you're making above that. What's the difference between an S corp and a C corp? Good question. And it can become a little bit confusing because the IRS uses some jumbled up terminology sometimes, unfortunately. But really the difference between an S corp and a C corp is a C corp is a legal structure, an entity structure like an LLC. A C corp is a business structure. It's a business entity like an LLC. An S corp is a tax election. So an S corp is not necessarily a corporation, oddly enough. It's a way to ask the government to tax your business entity a certain way. So you can make an S corp election on either an LLC, or you can make an S corp election on a C corp and turn it into an S corp. But yeah, that's how that works. Why is an S corp called a corporation if it's not? Well, here's one of the reasons. Is the IRS, in terms of their terms, a lot of times they'll even refer to LLCs as corporations. So really, the term corporation in the IRS's eyes, just in general, means a business entity. In a lot of the forms that you fill out with the IRS, like when dealing with the LLCs, you'll see, like, for example, they'll ask you for date incorporated or incorporation date or whatnot. But they're also just asking for the date of your LLC formation date, even though you're not a corporation. But corporation usually just means business entity in the IRS's eyes. So the reason they call it S corporation is just because it simply means that there is an S election on a corporation. And that encompasses LLC. Like the term corporation in the IRS's eyes encompasses LLC, corporations, and entities, separate entities like that. It's a really good question, by the way. What's the difference between an LLC and a partnership? Well, there's not, technically, because a partnership is an LLC. More specifically, a partnership is a multi-member LLC. A partnership is nothing more than two or more people that own or are on an LLC's ownership papers. Essentially what it is. And so like in your articles of organization, if two or more people are listed as managers or owners in there, in that paperwork, that is a multi-member LLC, that's a partnership. So, but what happens though is it's technically an LLC, but the IRS now looks at that automatically as a partnership for tax purposes, which means you now have a partnership tax return that you got to file. It's called Form 1065. So it can be a little complicated sometimes when you form entities and you need to understand how they relate to the IRS and all of that. So it's a lot of times it's a good idea to get some support, with some of these things. Okay. What exactly is a nonprofit? Ooh, okay. That's a good question. I haven't got a question like that in a while. A nonprofit, essentially, it's not a business entity, but it is an entity that's formed with a no-profit motive. So since it doesn't have a profit motive, it gets tax benefits. It's not taxed on its profits because those profits are not being paid out to an owner of some nonprofit as income. Then it would be a business. But it's not taxed since that's not happening. The money in a nonprofit, in order for it to get that tax benefit, in order for it to be a nonprofit, has to be spent on the social purpose, or not even the social purpose, or the purpose for the nonprofit. Money has to be spent on that for it to be tax-free for the nonprofit, or for the person running the nonprofit, and not to be accused of running a fraudulent nonprofit. But essentially, it's an entity to where money can run through it. And as long as that money is used for the purpose of that nonprofit and not to make a profit, there's no corporate tax or anything on it. And there's some situations where people will have a nonprofit and will also have a business, and they'll do business with one another. But that's also another area where you very much need to speak to an attorney before you do anything in that regard. All right, I think I have time for one more questions here. I didn't file taxes last year. How do I maneuver this year? Well, the first thing you should do is just file last year's tax return as soon as you possibly can. Because one thing now, especially if you owe taxes on the tax year that you didn't file for, penalties and interest are accruing right now. Not only that, late filing penalties are accruing, and those are steep. So the first thing you do is get that late tax return filed as soon as you can. And then the next thing you do for the 2024 tax return is either file an extension for it, which of course that gives you some more time, or file that one by the due date, by April 15th. And you should be all set. But that is all the time I have today. I actually have to go and help out some collective members. But I enjoyed it very much. You guys asked some excellent questions, and I hope to see you around collective.